Hello, my name is Jennifer and I am with Interior Savings and I'd like to welcome you to our webinar. We would like to respectfully acknowledge that Interior Savings is situated on the traditional, ancestral, unceded territory of the Syilx Okanagan Nation. I would also like to acknowledge that you are joining us today from many places near and far and acknowledge the traditional owners and caretakers of those lands. Welcome to the 11th Annual Okanagan Embrace Aging Month, and thank you for joining us today. Embracing Age is co-hosted by the Institute for Healthy Living and Chronic Disease Prevention at UBC Okanagan, Interior Savings, and Interior Health. UBC Okanagan has joined the global network of age-friendly universities, formalizing its pledge to make UBCO more accessible, intergenerational, and committed to research programs that are informed by the needs of aging society. If you would like to know more about the Age-Friendly University Initiative, have suggestions for us, or would like to get involved, please contact the Aging in Place Research Cluster. The website is aginginplace.ok.ubc.ca, and we will post that link in the chat box. Embracing Age Month was launched 11 years ago to celebrate and raise awareness about positive aging, and has once again organized a number of educational opportunities and events during the month of March. The sessions are designed for everyone, young and old alike, and focus on a variety of topics related to healthy aging and ways to improve quality of life among seniors and their family caregivers. Our goal is to inspire everyone to embrace positive aging. There is a closed caption box, which you can move to your preferred place by clicking and dragging it to where you would like. And to turn closed captioning off, you can select the Hide Caption button on the menu bar. And then you can type in questions or comments for the speaker into the chat box during the presentation. Questions can be addressed during the slideshow, and as well, we will read at the end of the presentation. Today's event is brought to you with the support of Embracing Age Month. Today's session is Strategies for Navigating Home Ownership Through Retirement. Our speaker is Charles Sherman, Mortgage Specialist at Interior Savings.
Okay, so today we're looking at the impact of retirement. The impact of retirement has on qualifying for a mortgage, what mortgage options are available, what reverse mortgage options, what reverse mortgages are and how they differ from standard mortgages. We're going to review how bridge financing works, along with some of the risks with using bridge financing and other considerations that may impact owning a home when retired. Good afternoon, my name is Charles Sherman, and I want to say thank you very much for being here today. I'm a mortgage specialist, which means I primarily work with our members to assist them with their mortgage financing needs. I mostly work with new members, though I do work with existing members as well. I've been with Interior Savings for over 7 years now, with the majority of the time being spent in various roles in our local branches. I previously attended Okanagan College, where my education was centered around financial planning. I'm also a local small business owner, and my family and I have lived in the Okanagan for the majority of our lives. I often have a lot on my plate between my work life and personal life, though that's mostly my fault, as I have trouble saying no when people ask me to participate or take part in events and initiatives in and around our community, such as with Embrace Aging. If anyone needs anything to be elaborated when discussing a topic, then please don't hesitate to ask a question in the chat box, and then I will try and elaborate that, essentially your question when discussing that topic. If there's any larger questions or overreaching questions, then we will try and address those towards the end instead. So that can include any complex questions or questions even on something I did not discuss. Feel free to ask, and we will answer to the best of our ability at that time, though we may take something offline if needed, if something requires more information from yourself. There will also be a slide at the end of the presentation with contact information for you to reach out afterwards if you wish. So without further ado, let's jump into it. So approaching retirement can greatly impact your ability to qualify for a standard mortgage, as there are numerous changes happening all at once. And depending on the situation, it can be hard to reliably demonstrate what your income will be going forward. usually related to employment income and investment income. Pension income is usually quite clearly defined as you are either entitled to receive a pension, or if you're entitled to receive a pension, then you are either receiving it or you're not yet receiving it. And if you are receiving it, then it's usually just a question of how much you're receiving. Pension income is quite stable in that you will almost always receive at least a certain amount for the rest of your life. So there isn't a lot of risk from an income stability standpoint. As I noted, where there's often ambiguity is with employment income or self-employment income or investment income, usually related to a reduction or fluctuation in income when transitioning to retirement. If you're continuing to work full-time or part-time past a traditional retirement age, then we typically can use your employment income for qualification purposes. On the other hand, if your income is coming down or you don't have guaranteed hours or there just isn't a clear or reliable expectation around how much you will earn going forward, then it can become difficult to use that income for qualification purposes, regardless of the source. The same principles are applied to investment income. At some point, you will transition from contributing to your investments to drawing an income from your investments. And when you do, we typically can use your investment income for the purposes of qualifying. A 2-year average of what you would draw from your investments is typically used for income, given that the level of income in relation to your investment balances, so how much you're taking out versus how much you have in your investments, given that is sustainable over the life of the mortgage. If you're not drawing from your investments yet, or the amount of income you have been drawing has been fluctuating, then that can make it difficult to use your investment income for mortgage qualification purposes. The length of the mortgage is something else that's looked at when qualifying. The amortization used for mortgage qualification can be as long as 25 or 30 years. So say you're 65 now and you're qualifying for a new 30-year mortgage, then you're potentially looking at paying off that mortgage until, like making payments towards that mortgage until you're 95 years old. If employment income is being used to qualify, then it's also important to look at what your long-term plan is in this scenario. Or as in this scenario, it's not expected that you're going to continue working until you're 95 years old, but we are using employment income to qualify. In a situation, how would you expect to continue making the mortgage payments if you expect to live in this property for the life of the mortgage, so until potentially you're 95 years old? So it may be in your plan to downsize at some point or transition from a regular mortgage to a reverse mortgage or another solution once your income goes down, which is completely fine as long as that fits within your future plans. So it's just a matter of having an idea of what's going to happen going forward. Generally speaking, the majority of mortgage qualification requirements and the application process are the same regardless of your age and whether you are working or retired. When someone discontinues working, it's expected that their income will decrease as their income becomes fixed and their expenses stabilize, which can make it harder to qualify. The biggest takeaway is that it's easier to use income from any source given it is stable and that it can be demonstrated where the expectation of future income or what it will look like. When there are fluctuations or variances in your current and expected income, then it becomes difficult to use that income for qualification purposes. One second here. I'm just going to take a look in here and see if I can adjust my income because we've had a comment about or my volume rather. Something I usually discuss with my members is the option to defer your property taxes. If you meet all the eligibility requirements, then it isn't a bad thing to consider, given that the deferral interest rate is quite reasonable. Floating usually at prime -2 for the standard deferral program. There are other deferral programs as well, and they have different interest rates, but the standard mortgage deferral or property tax deferral program is prime -2, though the rate is set periodically, so it can lag behind changes to prime. This rate is likely to be lower than any non-mortgage related debts, and it's possibly going to be lower than your mortgage rate as well. Please take a look at the gov.bc.ca property tax deferral website for the full qualification requirements, as there are different ways to qualify to defer your taxes, and deferring your property taxes may or may not be beneficial for your situation. It's something that I always recommend considering, of course. We will post the link here in just a moment in the chat. When you aren't able to qualify under standard mortgage qualification guidelines, then there's a possibility to qualify under an alternative mortgage program, given that you meet the requirements. These programs can have additional fees and higher interest rates, though, so it would be a good idea to look at all of your options and see if proceeding this way makes sense in your overall financial picture. Many lenders will use net worth programs where they base your lending on that they will offer you on your investments. Though keep in mind, these programs are specific to individual lenders and their guidelines may vary. Interior Savings uses an equity program or a non-income qualifying program for these types of situations where we look at your whole financial picture and verify that you have the means to reliably make the mortgage payments from an alternative or non-standard source, such as from investments or another source. Your overall financial situation is very important, and we need to make sure that you are able to make the payments. We would not lend to you under this program if we can't justify how to make the payments. So once again, talk to your lender or talk to whatever lender you deal with in regards to what alternative programs they have. If you're not able to qualify under standard guidelines, their qualification requirements will change. It'll be dependent on the lender. So. A question I'm often asked is should I obtain a home equity line of credit or a mortgage secured line of credit prior to retirement? My opinion is that a home equity line of credit's not a bad idea as long as you don't have issues managing revolving credit. Because of course, if you're not able to manage revolving credit properly, then it's not a good idea to take that on. Mortgage secured lines of credits or HELOCs will have a lower interest rate than an unsecured line of credit. Though keep in mind that a mortgage secured line of credit is secured by your property and is usually traded the same as a mortgage from your home insurance's perspective. I note this because if you're mortgage free with a clear title, then you can often get a discount on your homeowner's policy, your homeowner's insurance policy. Usually when you don't have any mortgage secured lending and you have the clear title, those are usually the situations where that discount would apply. But if you do have a mortgage secured line of credit, then usually you can't get that discount. Lines of credits are excellent when used as an emergency fund or for future minor expenses, short-term lending needs, or any other situation when you require access to credit. The qualification requirements for obtaining a mortgage secured line of credit are usually very similar to obtaining standard mortgage financing. Often I'll hear people in the industry recommend that you obtain as large a line of credit as possible before you retire, though I strongly caution against this. Having a line of credit in excess of what you anticipate possibly requiring down the road can be a liability for you if someone gains access to your online banking login and password, as they could log into your online banking using your login and then advance the line of credit a limit amount. So if you have a couple $100,000 available, they could advance that full amount and then transfer it out by a bill payment or another method. And then that would possibly leave you responsible for the full amount. And if so, then that could be extremely detrimental to your retirement. My recommendation is to obtain a line of credit that's suitable for what your future needs could be. But I wouldn't recommend going above and beyond what you anticipate possibly needing down the road. So a misconception I hear constantly is that having an unused HELOC or mortgage secured line of credit will protect you if someone wanted to fraudulently sell your property or someone tried to steal your identity and register a mortgage against your property. The rationale that I hear when I hear these claims is that the ownership can't be changed if there's a charge on title, or that a new mortgage can't be registered if you have an existing mortgage charge on title. Unfortunately, these are misconceptions. Both these reasonings are incorrect, and there's no guarantee that an unused home equity line of credit or unused HELOC will protect you from either type of fraud. I'm happy to discuss this further if they want to discuss, but to keep it simple, if you pay off your mortgage and you don't have any active lending, then I would recommend looking into whether you have a title insurance policy, an owner title insurance policy. And if not, then I would recommend looking into it further to see if it would be a benefit for you to get one. If you purchase your property recently, then you can check with your solicitor or check the paperwork that you received from your solicitor to see if they automatically registered an owner policy, as some solicitors do this by default. Title insurance is a one-time cost, and it should be relatively inexpensive. Now, please note that a lender policy and an owner policy are different types of title insurance. Often a lender policy is registered when you purchase a property and you get a mortgage. But just because you have a lender title insurance policy does not mean that you have an owner title insurance policy. So it's important to make sure that you have the right coverage if you are going to proceed with paying off your mortgage and not have any active lending going forward. So bridge financing. This is a complex topic, and it's one that people often like to use or they want to use, but often they can't qualify. So bridge financing is short-term lending that's obtained against a property when you've sold or trying to sell the property. And it's usually used to facilitate purchasing a new property. So you're selling a property, you're looking to buy a property, you would use bridge financing to facilitate buying that new property before you sell. Bridge financing is available to anyone who meets the requirements, though it's usually utilized by older or retired homeowners to provide them more time to move to their new home. Generally speaking, there are two types of bridge financing: standard bridge financing and non-standard bridge financing. Standard bridge financing is offered by the majority of financial institutions, and it's where you have a firm sale and a firm purchase. So someone's buying your property and you're buying someone else's property, but you're going to proceed with your purchase before the sale actually happens. So let's say I'm buying a property at the end of March, so in 2 weeks, but the people buying my property, they're not going to buy it until the end of April. Then I'll have a 1-month time frame in which I own both properties. If I have a firm sale, then that would be standard bridge financing because someone is contractually obligated to buy my property and I'm contractually obligated to buy somebody else's property. And it's known what that time frame is going to be. It's going to be approximately a month that I own both properties. Once again, that's standard bridge financing, and the majority of financial institutions are comfortable providing standard bridge financing. Non-standard bridge financing is when you do not have a firm sale, but you still wish to proceed with a purchase prior to your property selling. The majority of financial institutions do not entertain these types of situations unless you can fully qualify for the mortgage payment and the expenses related to both properties, which is quite rare given the large amount of income that would be required to do so. I personally have had decent success in obtaining approvals for non-standard bridge financing, given that the situation can be adequately mitigated, usually via savings or investments as mitigation, or potentially using a cosigner or indemnitor. Now, I'll preface that with saying that I work for a credit union, of course, and credit unions are often they'll do different types of lending than banks. They'll do lending that's they'll support people more. That's just kind of my experience. But it all depends on your financial situation, of course. I have heard of banks doing non-standard bridge financing, but I've also seen them not willing to entertain them as well. Now, non-standard bridge financing is quite risky because it uses open loan interest rates, which are quite high. And there's no guarantee that you're actually going to be able to sell your property for the price that you're looking at, or the price that you're looking for, rather, which can be disastrous in a buyer's market or when home prices are declining, given that you may have to reduce your selling price in order to sell the home. So it can be very, very risky. I've seen situations where people lose a couple $100,000 because they paid for their interest costs and then they have to reduce their selling price. It's not a good situation. It's definitely not something you should take on lightly. So there's also risk in proceeding with standard bridge financing, even when you have a firm sale, but given that the sale may not actually complete. There are situations where someone they're contractually required to buy your house, but they don't actually complete on the purchase. And then that leaves you in a situation where you own two properties. In those situations, you do have potential recourse, given that you have a signed sale agreement and they've given a deposit and whatnot. So there should be legal recourse, but you still have to manage the situation. In the meantime, you still have to potentially pay the short-term lending fees and the interest costs over that time frame. Potentially, it's still not a good situation to be in. There are many requirements for bridge financing to be able to qualify. So please ensure you speak to your lender in advance of needing this option just to make sure it's viable for you. Just because you are selling before you buy doesn't mean that you actually qualify for bridge financing. There's still requirements you have to meet, and there's equity requirements, and each lender has their own requirements in that. So make sure you talk to somebody first. So next, we're going to move on to reverse mortgages. It's an important topic for me to cover because there are so many misconceptions out there as to how reverse mortgages work. And as a result, there's people that would benefit from using a reverse mortgage, but they don't actually end up getting one due to misinformation or due to bias. There's a lot of bad information from reverse mortgages from other countries because they operate differently in different countries. A reverse mortgage is a solution for those, like it's available to those people who need it, but it's definitely not suitable for everyone. So if you're in a position where you can qualify for a mortgage, a standard mortgage, and making the regular mortgage payments is within your budget, then likely a reverse mortgage is not suitable for you. So please note that Interior Savings uses Home Equity Bank and their reverse mortgage products, though there are other reverse mortgage providers in Canada. The information I'm reviewing today is applicable to CHIP reverse mortgages from Home Equity Bank, and it may also apply to other reverse mortgage companies, though please do your own due diligence in confirming that the information is the same. If you're interested in a reverse mortgage as a solution for your needs, then I would be happy to facilitate a more in-depth conversation between yourself and our local Home Equity Bank account manager. So what is a reverse mortgage? A reverse mortgage is a loan secured by the appraised value of your home. It's designed exclusively for Canadian homeowners age 55 and older, and enables you to convert up to 55% of your home value in a lump sum takeout or reoccurring advances while staying in your home. You don't have to make any regular payments or pay back the loan until you move or sell, though you do have the option to make interest-only payments and annual prepayments with no penalty, up to the limits, of course. One of the benefits of a reverse mortgage is that it's actually easier to qualify for this versus other lending options, given that the basic requirements are based around your age and your home equity, not income. So basic requirements are that you have to be a Canadian homeowner, age at least 55 plus, and that is your primary residence. The amount that you qualify for will depend on factors such as your age, the appraised value of the home, its location, and the type of home. So if someone had a home worth 500,000 in Kelowna versus a home worth 500,000 in, say, in Midway, which is a small town in the south here, you won't qualify for the same amount on a reverse mortgage on the Midway product or the Midway home. You would qualify for more on the Kelowna home, just given it's in a different market. A reverse mortgage is a secure solution for accessing home equity without being required to pay any regular monthly mortgage payments. So it allows you access to tax-free cash without having to move, sell, or downsize, which actually aligns with aging in place, given that you can easily access your home equity without being forced to move. As the reverse mortgage proceeds are tax-free, utilizing a reverse mortgage will not impact your old age security or guaranteed income supplement benefits that you may be receiving. With a reverse mortgage, you always retain your ownership of your home and maintain title, which is the same essentially as having a mortgage through another lender. That doesn't differ. Though a reverse mortgage, you are never forced to move or sell, even if your income changes or your home value changes. The amount that you or your state eventually has to repay will never exceed the fair market value of your home at the time it's sold, regardless of your home's value. So if your mortgage value increases beyond your home value, then you wouldn't have to pay back the difference. Whereas with regular mortgage, if for whatever reason your home value decreased and your mortgage exceeded your home value, similar to actually what a lot of people are dealing with right now when they bought at the top of the market and the market's come down now and say they had variable rates. This is the most common situation. They had a variable interest rate. Some people are underwater because their mortgage exceeds what their home value is. Some people. So if you were to sell in that situation, you have to pay back the difference. Whereas a reverse mortgage, if your mortgage increased beyond the home value, you don't need to pay it back. You're not on the hook for it, given that, of course, that you meet all the terms and conditions of the reverse mortgage. Now, on the flip side, if your home value goes up and when your home is sold, you retain any appreciation, the difference between your sale price and the payout amount of your mortgage. You do keep your home equity. The main requirements to have a reverse mortgage is that the property needs to remain in your primary residence. So you can't move and still keep the reverse mortgage. It has to be your primary residence. You need to maintain the property, so you have to keep it in good condition. You need to keep active homeowners insurance and maintain your property taxes. So you can't not pay for property, or you can't not pay for homeowners insurance. Sometimes people will eliminate homeowners insurance to try and save some money, but you have to maintain your homeowners insurance and you have to maintain your property taxes. Now you can either pay your property taxes or you can defer them, either or, doesn't matter. Both are viable solutions. Now, I should note some additional information regarding the legitimacy of home equity bank and reverse mortgages in Canada, specifically from Home Equity Bank. So Home Equity Bank is a Schedule 1 federally regulated bank, so which means they're bound by the same regulations as the banks that you're familiar with, like BMO, RBC. Those are Schedule 1 federally regulated banks, same as Home Equity Bank. Now, there's a company called Ontario Teachers Pension Plan Board, which they're administrator of Canada's largest single profession pension. And I'm assuming you can guess by the name that they manage the Ontario Teachers Pension Plan. Something I just learned is that in 2022, the Ontario Teachers Pension Plan, they acquired the parent company of Home Equity Bank. So Home Equity Bank and CHIP Reverse Mortgages is actually owned by the Ontario Teachers Pension Plan, and they fund CHIP reverse mortgages that you obtain. Ontario's teacher pension plan is actually the one who funds them. So just interesting information I just learned. Now we do have a comment here asking something about reverse mortgages. I'll address it at the end here, just about the viability and whether it's appropriate for somebody. So as far as interest rates are concerned, reverse mortgages do have higher interest rates than a standard mortgage. So a standard mortgage and a home equity line of credit, you have to qualify for these products income-wise, and you have to make regular payments against them. So they have better interest rates. Reverse mortgage, you don't have to make any payments. It's based on your home equity, and of course there's strict requirements. So the interest rate for this product is higher. So it's often lower than some other options, such as an unsecured line of credit or private equity lending or credit cards and so on and so forth. So the interest that accrues on your reverse mortgage is added to the mortgage balance, assuming that you don't make interest-only payments, of course. So this means that your total mortgage amount owing, it will increase over time. Now, there's also other costs associated with obtaining a reverse mortgage. They include, and not limited to, home appraisal fees, setup costs, prepayment penalties if you pay off your reverse mortgage before it's due, legal costs, closing costs for if you purchase a property and obtain a reverse mortgage on it right away. So many of these costs also apply to obtaining mortgages like a standard mortgage, but they will vary on the situation. So for instance, when you obtain a standard mortgage, most of those costs I mentioned will still apply, except for, say, a setup cost. When you get a standard mortgage, usually there's no setup cost or fee. But if you were to obtain alternative lending, such as a net worth mortgage or an equity mortgage, usually there are fees with those. So it really does vary on the product, the type of mortgage that you obtain. But in a lot of ways, a reverse mortgage is similar to a regular mortgage in these other areas. So to elaborate, who qualifies? Essentially, everyone that's on title has to be at least 55 years old. So if you have any children on title, they have to be removed. If you have a spouse, even if they're not on title, if you have a spouse like a common law partner, if they're under the age of 55, you actually can't get a reverse mortgage because it's based on the youngest person there. So if you're 60 and your spouse is 54, you do need to wait until they are 55 years old. So you have to live in and own your home. You can't move out of the home. If you do, then you are required to pay out the CHIP reverse mortgage. It has to be your primary residence. Max loan to value. So the max amount that they can lend against the property has to be less than 55%. That's the absolute max that they'll lend. Of course, it's based on factors such as your age, the home value, the home location, and the home type. And you must hold valid and adequate homeowners insurance, as with any mortgage. It's required. And same thing for property taxes. You have to maintain your property taxes. So Home Equity Bank has 4 different programs which they offer, 3 of which are commonly used. The 4th one is just a product where they can advance you more money, a higher amount than they normally would, but they charge you more fees. So I'm not going to bother addressing that product. Their first product is their standard reverse mortgage, which is the most common type reverse mortgage you see. It's where you receive a single advance, you receive the funds that you need. A second option is called their Income Advantage program. And in this option, you receive regular scheduled advances, which would supplement your income. So similar to like a pension, you get a monthly deposit. That's how this would operate. You would receive a monthly disbursement or whatever frequency per their terms and conditions, of course. You receive that regular disbursement from the reverse mortgage. This option can be beneficial because it can supplement your income if you simply don't have enough income, but you have a large amount of equity in your property. Or it can be used in other situations, such as preserving your investment portfolio for longer and lowering your long-term tax liability. Given that reverse mortgage disbursements are free, then it essentially allows you to access your home equity in conjunction with utilizing your investments. Always make sure you consult with an accountant or a financial planner when looking at these types of strategies, because they're often complex, and you want to make sure that you're doing something properly, that you're not just jumping into something. CHIP's third option for a reverse mortgage is an open term, which is commonly used for short-term lending, such as bridge financing. So this can be beneficial for you if you're not able to qualify for non-standard bridge financing options through a financial institution, but you do meet the equity requirements for a CHIP open loan. So for instance, when I have a non-standard bridge approved, usually when they don't qualify to make the payments, usually I'm mitigating it using savings. But if somebody doesn't have any savings, it becomes very difficult to do that. And that's where an option like this may be of benefit, because they just look at your home equity. They don't look at savings. They don't look at alternative ways to make the payments. And they also have lower equity requirements that they look like. They won't lend as much. So it definitely has to make sense, and you have to meet the eligibility requirements to use the product. There are many situations in where you may benefit in using a reverse mortgage, though it definitely has to make sense for your situation. There are a lot of situations out there where it does not make sense, and it just doesn't make sense to use a reverse mortgage if it's not the right thing for you. And that's where I think reverse mortgages get a bad rap. It's from the States. Primarily is because there's less regulation, less requirements, and so some people that maybe aren't advised properly are put into these products, and they really shouldn't be. So to summarize some of the strengths and weaknesses of a reverse mortgage, strengths include that you don't have to make any regular payments, which can be beneficial if you simply don't have enough income to make mortgage payments, but you do want to continue living in your home. It allows you to access the equity in your home without having to sell it, which means you still own and live in your home while you're accessing this equity. You may have options as to when and how to receive the money. So whether you receive a lump sum or whether you receive installments, such as to supplement your income, though those options are all available to you. The proceeds are tax-free, so you don't pay any tax on the money that you borrow. And then as a result, it doesn't impact your old age security or your guaranteed income supplement benefits that you're receiving. Just because it's non-taxable. Sometimes people will start to draw more money from their RSP or their RIF, and then it will impact their GIS or their OAS because their taxable income goes up. This taking disbursements from a reverse mortgage will not do that. You will not owe more than the value of your home. So if your mortgage balance increases beyond the value of your home, then you will not owe the difference back when selling your property. Of course, given that you follow the terms and conditions of the mortgage. Same thing for a regular mortgage. There's always terms and conditions. You need to follow the terms and conditions of the agreement. Some of the weaknesses of a reverse mortgage include that interest rates are higher than the standard mortgage and standard HELOC. The equity that you hold in your home may go down as the accrued interest balances increase. So essentially, your interest accrues against the mortgage. It could accrue faster than the value of your home going up, and so then the mortgage and your equity could be eroded. So then as a result, there could be less money in your estate that can go to your children or other beneficiaries. So you have to consider that as well. I'm going to address this question we had here. So we had someone that spoke with a mortgage broker recently, and they just declined discussing this option. They said that they're not a fan of the product. They're not a fan of reverse mortgages. I don't agree with not discussing it. Everyone has their own personal biases, of course. There are plenty of situations where a reverse mortgage does not make sense. There are also plenty of situations where it does make sense. So I don't agree with just not discussing this option because you're not a fan of it. It definitely needs to make sense for your situation, though. It's one option that's available, and it should be considered along with all the other options. But once again, back to one of my original comments is that if you qualify for a mortgage and you have the cash flow and the ability to make regular payments without impacting your retirement, often a reverse mortgage is not the right solution for you. But if you don't have the ability to make your payments, then often it can be the right solution for you. Now, there are ramifications from using a reverse mortgage, like your equity can be eroded, but it does allow you to stay in your own home. So you have to determine what's most appropriate for you, what's the best thing for you. Sometimes it makes more sense to sell your property and move into a rental or buy something like downsize or right size, as they use the term here. That's fine too. It has to be whatever solution is the best for you. There's no one solution fits all. There's a couple situations that I have here. For instance, you have a family member that is looking to help in this situation, the grandpa that's looking to help his grandson with a down payment. Perhaps he's on his fixed income. Maybe he has only CPP and OAS. His income sufficient to pay for his home related expenses, but maybe it's not enough to qualify for a mortgage. In this situation, this person was referred to Home Equity Bank. They were able to take out 100 or 400,000 against their property. They had enough value in the property to do so, and then they gave that amount of money to their grandson, and their grandson was able to obtain a mortgage for the difference, and he was able to purchase his property. Without a reverse mortgage, Grandpa wouldn't have been able to assist with that. He wouldn't have been able to help. Another situation here is bridge financing. So an 80-year-old female lives in her home worth 900,000. Typo there, 900,000 on it. She's looking to buy a home with her son, but she wants to buy before she sells. She doesn't qualify for a non-standard bridge loan due to income, which is often the circumstances. So she got a CHIP open loan for 300,000, and that helped facilitate purchasing the new property. And then that was paid out with no penalty when the sale closed. So there's lots of options that are available. They definitely have to make sense for their situation, though. Someone else here asked if a lump sum could be used for anything. Yeah, no. So if you get a CHIP reverse mortgage, you can literally use it for anything, whatever makes sense for you. Like for instance, here's a list of some options that make sense. So right sizing or downsizing, purchasing something else, gifting a down payment, separation in your retirement years, bridge financing. Those are just some suggestions. Definitely, if you don't qualify for lending and you want to proceed with a situation, you want to proceed with something, then you can use the money for whatever you need to do. Of course, given that it makes sense for your situation. So, and though this person specifically asked about living in another property for 6 months, yes, you need to live in this property for 6 months of the year, but you can live somewhere else for 6 months. That does count as this still being your primary residence. If you were to live in this property for less than 6 months of the year, though, then it's no longer your primary residence. So you do have to maintain that primary residence eligibility. So I am about 5 minutes early here on my presentation. So we have a little bit more time for questions. Feel free to type anything you want into the chat box, any questions at all, whether it's something that I reviewed or something that you have a question about that maybe I didn't review. Doesn't matter to me. I'm open book. Now, there's also some information there for myself and for Jennifer. Feel free to reach out to us outside of this as well if you have any questions or if you have specific information that you're looking for. We're always available. So we had someone that asked here if we have any information on Bloom Reverse Mortgage. So Bloom Reverse Mortgage is a reverse mortgage company. Actually, it was recently started. So it's a recent company. They were started by, as far as I know, some ex home equity bank employees. I don't have much information on them. I know that they're not listed on the government website in regards to whether they're a Schedule 1 federally regulated bank. They're not listed. Beyond that, I don't have much information about them. They don't have they're newer, so they don't have a track record. Like home equity bank's been around, I believe, since '86. Another long-term one is Equitable Bank, but yeah, I don't have much information on Bloom otherwise. Part of that too is that we Tier Savings doesn't deal with them. We only have home equity bank for our reverse mortgage partner. If you are interested, though, in more information about Bloom, I would encourage you to look them up online or talk to a mortgage broker because mortgage brokers have some more options with reverse mortgages. They deal with more lenders, and it may be an option that's more suitable for you for sure. But definitely consider all your options. So someone else had a question here regarding having people on title, like a child on title of their property. Um, it's not something that it's something that you want to talk to about with a lawyer or with a financial planner. Adding a dependent or not a dependent really, it's a child to your property when they don't live there. It could have unintended ramifications. Some people use it as a way to do estate planning, but yeah, no, it could have unintended ramifications, which you definitely want to talk to your lawyer about. Ask them about liability issues with that. There's also some new rules that came in this year in regards to having to file taxes, having to file like a trust return, I believe, in certain situations, and having ownership in a property that you don't live in, I believe, is one of those situations. So it may also be something you want to talk to your accountant about and see if it makes sense. So we had another question here in regards to they asked so up to 55% loan to value on the home's value based on age. So how much does that vary, say, at age 65? I was told that only 25% is available by a mortgage specialist. So it definitely depends on all the factors I noted. So it depends on your age, of the youngest age, or the age of the youngest person who lives in the house, the home's appraised value, the location, and the type of home. So I can't really give you a firm answer based on just the age because there are all those other factors as well. I will show, or I will be able to tell you though that on CHIP's website, I'm just going to bring it open here and put a link. They have some calculators which can help you calculate potentially how much money you could access in a reverse mortgage if you were to want to proceed that route. And I will locate this link here right now. Actually, I'm going to post two calculators. Um, so here's the first one for estimating how much funds you could access against your home based on all those factors. And then there's another one here that's a tool I really like. It's a home equity calculator. So it calculates um, how much interest is going to accrue based on the mortgage balance you have and the interest rate, but then also potentially how much equity you can accumulate in the same time, and then it offsets them over whatever time frame. So if you anticipate having the reverse mortgage for 10 years, you can roughly guesstimate how much home equity you will have at the end of that time frame. So we had a question regarding how you can pay back a reverse mortgage. So reverse mortgages, unless you have an open type product, you will have prepayment penalties. So those are your penalties for paying off the lending. You have the same types of penalties for standard mortgages as well. How they're applied is slightly different, of course, because it's a different type of product. But a prepayment penalty is not something that's unique to reverse mortgages. So with a reverse mortgage, if you move away out of the home, you have to pay off the reverse mortgage either by selling the property or remortgaging it with a standard or essentially paying off the mortgage from any proceeds. Doesn't matter where the funds come from. If the last surviving mortgage holder passes away, then the property needs to be sold and the mortgage needs to be paid off anyways. And then, of course, if you sell your home, the mortgage has to be paid off. There are timeframes in which that prepayment penalties would apply. Now, for CHIP, they're related to how many years you've had the reverse mortgage. So if you pay it off after 1 year, you'll have a higher penalty than if you pay it off after 2 or 3 years. I believe after 5 years, you don't have a penalty anymore if you were to pay it off after that time frame, regardless of what term you're in. But that's something that we would need to determine or double check, of course, with a home equity bank account manager, because they would have accurate information as to what prepayment penalties are and how they're applied. Um, it's a good question to ask in advance, of course, because you want to plan out your future and make sure that you're not incurring a penalty by doing something because you didn't plan ahead. One second here, I'm just pulling open someone's question. So someone asked about whether a reverse mortgage is a good idea, just in general. They posted a link actually for an article. Really, whether a reverse mortgage is good for you, like this reverse mortgages aren't bad, they're not good. It's just another option that's available to you. Whether a reverse mortgage is good for your situation or not really depends on your situation. Once again, if you value the benefits of using a reverse mortgage, then it could be good for you. But once again, too, if you have the ability to make a regular mortgage payment or you have the cash flow to do so and you can qualify, then it may be that you're paying extra for a reverse mortgage when you don't actually really need it. So it's not a matter of whether they're good or bad. It's more so an issue or a matter of whether it's good or bad for you. There are definitely strengths and there are weaknesses to it, just like there are with any other type of mortgage. With regular mortgages, there's strengths and weaknesses as well. Same thing for a home equity line or credit. Somebody asked about interest rates, actually. So whether a fixed rate or available rate is a better option right now for a reverse mortgage. And feel free, if anyone has any questions about other topics too, feel free to ask. Of course, not just about reverse mortgages, though I anticipated having more questions about them just because there's lots of misconceptions about reverse mortgages. So someone asked about fixed versus variable right now for a reverse mortgage. It really depends on the rate too. Like I know CHIP's reverse mortgage variable rate right now is quite high. So you have to consider what you think rates are going to, what's going to happen with rates, what you anticipate happening as far as how long you're going to be in the property. There's a lot of consideration. Same thing as if you're looking at a regular mortgage, whether you look at variable or fixed as well. Um, it really will depend on where rates are and what your plan is for that property and how long you plan on being there, how long you plan on having the mortgage. So um, for a reverse mortgage, whether you have a fixed rate or a variable rate, you do eliminate some risk because you're not your payment won't change because you don't make payments. With a standard mortgage, if you have a variable rate mortgage, your payment could change because your interest expense could go up or it could go down. For a reverse mortgage, you don't have that specific risk, so there could be less risk. You could take on a variable payment with less risk tolerance potentially on a variable or on a reverse mortgage. But once again, if you are getting a reverse mortgage or your term is coming up and you're looking to renew, definitely look at the two options. See what makes the most sense for you for your situation. So someone asked, they wrote, I've been deferring my property taxes for a few years. Should I pay off this deferred amount before setting up a home equity line of credit? I'm looking at likely purchasing a downsized home before selling my current home. So actually, if you are deferring, you likely would have to pay off the taxes to be able to advance more lending. It's there's some requirements in the on the deferred property taxes form. When the financial institution fills it out, they record what your mortgage balance is, and they're signing that the lending they provide cannot exceed that. And essentially, the risk is that potentially they could be in a position where they're not covered by their first charge. So it's very likely that you would need to pay off your taxes, though make sure you talk to your lender, ask them about the situation, what's required. But my thought is that you will need to pay off your taxes before setting up that line of credit. Now, most lenders will allow you to pay it off from the lending that's set up. So the lending is set up, the taxes are paid off at the same time. So it's not like you have to come up with cash to pay it off yourself before proceeding. Um, and then as far as purchasing a home before selling your current home, I'm guessing that by setting up the line of credit, you're looking to use the line of credit to essentially facilitate that transaction. That's something I didn't talk about. Depending on how big your line of credit is, depending on what you're purchasing, you could use a line of credit to essentially act as bridge financing. I find often the line of credit somebody has is not enough to cover the purchase price of the new home. So often it doesn't work properly, but depending on your situation, for sure, it could help contribute towards purchasing the new property, or depending on how much you are downsizing, it could be sufficient for your situation. Um, Completely situational dependent, of course. Someone asked, do you have to pay for a home appraisal when obtaining a reverse mortgage? And then how much is that on average? So for a reverse mortgage, as far as home equity bank is concerned, anyways, yes, you do need to pay for the appraisal. Appraisal costs generally run between $350, $500, but it really depends on the area. It depends on the property type, its location. There are factors that play a part in the pricing, but generally that it's about 350 to 500, kind of in that range, and you do need to pay for that appraisal for a reverse mortgage. For a regular mortgage, it varies depending on the financial institution whether you have to pay. But for a lot of financial institutions, they either cover it with like an internal appraisal or you need to pay for the appraisal. Really depends. Someone here just asked about The obligations on a reverse mortgage. So what the borrowers are obligated to do. That will flow back to some topics or some items I previously mentioned. You're required to maintain your home when you have a reverse mortgage, exact same as if you have a regular mortgage. A lot of the aspects between a regular mortgage and a reverse mortgage are the same, because a reverse mortgage is a mortgage at the end of the day. You're required to maintain your home. You're required to pay all your property taxes, whether you pay them or defer them, doesn't matter. The property taxes are required to be current. You need to pay your home insurance, of course. You can't not pay your home insurance. And if you have a strata type property, so a condo or a bare land strata, or any type of property where you do have strata fees, you are required to maintain your strata fees. So you have to pay your strata. That is something else that I did not cover. But essentially, yeah, you need to maintain your home, keep it current. And those requirements are the same whether you have a reverse mortgage or a regular mortgage. Someone asked a question in regards to tax liability, in regards to pensions. Once again, the proceeds of a reverse mortgage are tax-free. Same thing as if you sell your house, it's all tax-free. So it does not impact your pension, does not impact your taxes, doesn't impact any of that, because the proceeds are tax-free. So you can use a reverse mortgage for supplementing your income, or for just taking that lump sum payment without impacting any of those benefits. Someone asked, can you get a reverse mortgage and then downsize and then get another one on the smaller property at some point while aging in place? So 100%, if you qualify to get a reverse mortgage on the new property, then that's not an issue. Essentially, it has to be your primary residence to get a reverse mortgage, and it has to be the equity requirement, and it has to be a property that home equity bank is willing to mortgage, because of course they will lend less on certain properties depending on if it's depending on its location and the property type. But so as long as it meets the requirements, then they will lend up to their limits. Same thing for a regular mortgage. You can have a mortgage on a property, downsize, get a new mortgage on the new property. It's all subject to the property being mortgageable, and then up to whatever limit the financial institution is willing to lend against. So I would encourage you to use the reverse mortgage calculator I mentioned previously, and see what a sample property similar to the smaller property that you're looking at. See how much you can obtain on that. See if it's enough for you. And I would highly encourage you to talk to a reverse mortgage account manager, because they are similar to how I do regular mortgages. They complete reverse mortgages. They know this inside and out, just like I know standard mortgage qualification and standard mortgage policy and procedure. They would go over your situation. They would calculate the numbers with you and make sure that your situation that you're looking to proceed with is viable. And if you need an open type product, if you need that bridge financing, then that could play into that as well, 100%. So we got 2 minutes left. Is there any last minute questions?
Thank you, Charles. And thanks everyone for attending today's webinar. So we encourage you to attend all other scheduled events for Embrace Aging this month, and please visit our website. It is OkanaganEmbraceAging.com for all our events and registration. As well, we look forward to growing this event in the Okanagan and encourage anyone interested in supporting Embrace Aging in the future to please contact us. Our contact information is available on our website. As well, at the end of the session, you will receive an email with a link to an online evaluation form, and we welcome everyone's feedback and suggestions for planning Embrace Aging events in the future. And feel free to reach out to us directly as well if you do have any specific questions about this session. Thank you.
Thank you, everyone.